Hi Vidya, how are you?
Good evening, Sam. How are you?
Doing good.
I'm doing good. Thank you.
सरस है थोड़ा स्पाइसी हम टेस्ट आते हैं
We'll get started in a
So,
few minutes.
yes, Sam. To all the participants today of this webinar, we would like to keep this webinar short and sweet. Sam will be talking about the Biden's tax overhaul and more topics. Today, we will not have a direct question answer session. Instead, you will ask the questions on the question and answer forum, and we will send an email to all the participants today with answers to all these questions. As usual, we appreciate you joining and the patience and support you guys show to us. Thank you.
Well, I'm sorry for not being able to take the live questions. I'm traveling internationally. Actually, I'm taking this webinar from Dubai. I'm in Dubai right now. So hope, as I said again, as Vidya mentioned, that if anyone has a questions, you please email to info@perfecttax.com, and we're one of the experts or me in next week we'll sit down and discuss more in detail. I'm going to be back in town, so I can possibly guide you more detail and possibly answer the question. The good news is I'm going to leave you with a lot of updates about the plan that Biden administration has for the tax law change updates coming in 2021. So for people who are filing 2020 taxes, either they have filed it or yet not filed it, these changes are not going to affect them, but these changes are going to be affecting everyone in 2021, filing in 2022. So that is what we are going to be focusing ourselves on. And that is very, very important because you got to start planning for those taxes in advance. I always say what you do between the tax filing in January through April is purely tax preparation, and it is not about planning. Planning always has to be done proactively, and it has to be done in a way, and it has to be done before end of the year. So I always say you cannot do it the last day also. So you should keep planning throughout the year as you start making income or have income. So Vidya, let's start with the next slide. So summary of key changes. Again, before we get into detail, this is Sam Tucker, Group CEO, Perfect Group of Companies. People who have joined this webinar for the first time, Perfect Group is divided into multiple verticals, and oldest vertical and the largest vertical, one of the largest vertical being the tax and tax planning. But we are also into media and entertainment. We are world's largest South Asian media entertainment company. We are into tax efficient real estate investing, where we can actually increase your in real estate investment returns by double digit because they're tax efficient. And that is very, very important because any real estate investment we do with the tax efficient strategy in mind. So if you are technically making 12% without tax efficiency, then with proper planning, the tax efficiency would increase your returns to maybe 20% or even higher with the tax efficiency. So today we are going to again talk and focus ourselves on the law changes that is happening, what are the rates changes that is coming up, and how you can proactively plan and strategize to help yourself. So summary of key changes: tax rates, schedules updated, new corporate tax rates, update to AMT tax, depreciation updates, repatriation of funds, pass-through income changes, overhaul of standard deduction, and changes to itemized deduction. So let's go to next slide, Vidya. So tax on business entities obviously is taxed differently. C Corp is taxed differently versus S Corp is taxed differently. S Corp partnership and sole proprietor do get added to you individually, and they're called pass-through entities, versus C Corp is a double tax entity. So you do pay taxes at a corporation level, and then you again pay tax when you take dividends from your company. You again pay taxes on that. So taxes on business entities are different, how they do get taxed. So there are various planning strategies available because in S corp, remember that you are supposed to take the payroll, and if you're not taking the payroll, S corps are very highly audited vehicles, so you have to take payroll, because when you take payroll, you do pay your payroll taxes, which is social security and Medicare taxes. In partnership, in sole proprietorship, LLC, all of them again being pass-through entity, you pay payroll taxes not as a payroll tax, but you pay it as a self-employment tax, which is also called SE tax, which is 15.32%. So let's go to next slide. There are various changes around this also. So business taxes explain. So how business taxes works? You add income from all sources. You subtract your cash expenses. You subtract your non-cash expenses, which are depreciation and those things. You calculate tax or pass through and deduct tax rates or pass through, which ultimately ends up being in your personal taxes. So it's like a funnel. You start on the top where your gross revenues are calculated, and then you subtract the expenses, non-cash expenses, which are depreciation and other things, amortization, depreciation, and you calculate tax or pass through, and ultimately you deduct tax rates or pass through income, and that final the income is taxed on your personal level or on your C corp level at a company level. Let's go to next slide. So corporate tax rate in 2020, this is for last year, is 0 to $50,000 is 15%. $50,000 to $75,000 is 25%. 75,000 to 100,000 is 34%. This is corporate tax rate. This is not personal tax rate. This is C corp. 100,000. So they are talking about, the current corporate tax rate is a flat tax rate of 21%, and they are talking about changing this tax rate to make it go all the way to 38%. So they are talking about increasing the tax rate. So excuse the 2020 is 2021. This is the tax filing for 2021. So sorry for that. There is a heading is incorrect. There is an error in the heading. But your corporate tax rates is in 2021 is planned to increase by this level from the current tax rate of 21%. They are planning to increase the tax rate by this level. And personal services company would have a flat tax rate of 35%. Personal service company is if you're into consulting or any of that kind of business, then that is a separate tax which you pay. If you're purely into consulting, you have to treat yourself as a personal service corporation, and you pay a flat tax rate of 35%. You don't get a tiered structure. Personal holding company again has the same effect. Corporate AMT, there is an additional alternate minimum tax they're talking about adding on corporate side, on a C corporation side. And they're talking about also adding accumulated earning tax. What is accumulated earnings tax is that if a lot of times people say, I don't want to distribute the income, I'm just going to accumulate that in C Corp. What happens is that if you accumulate your income in C Corp, eventually, even though you not take a distribution, they add a tax called accumulated earnings tax, which even though it is non-distributed, you do pay taxes on that. Unless and until you have a business justification or reason behind it. So this is the new proposed tax rate for 2021. Let's go to the next slide. A new kind of income, ordinary income, investment income, passive income, and qualified business income. So there is a new kind of income. So what they are doing is they are taxing now different income differently. Currently, we only have simple thing, which is an ordinary income. And then you technically have a business income also being added as an ordinary income. Then you have investment income, which is capital gains. And you have passive income, which is either active or passive in nature. And then you have qualified business, basically, but they are adding now an additional tiers on income structure. They are adding new income structure. Let's go to next slide. Current law is that pass-through business, which include partnerships, limited liability companies, ESCOM and sole proprietorship, pass their income to their owners who pay tax at their individual rates. Owner could apply a 20% deduction to their business income, subject to limit that would begin at 315K for married couples or half for single, which is called qualified business income deduction. This was introduced in 2017 as a qualified income deduction as part of the 2017 Tax Cut Act. This was introduced. So that is, if you're filing your taxes in 2020, this is a qualified business income tax deduction which is available. Yes, Ramakrishna, yes, I'm going to discuss personal tax also. I think Ramakrishna had a question. So I'm going to discuss personal tax as well. Let's go to next one. So again, we are talking about S Corp, partnership and sole proprietor. Let's go next one. Now, depreciation and expensing. There is a changes in that depreciation and expenses. Today, depreciation is business could fully and immediately deduct cost of certain equipment purchased after 27/2020 and before January 2021, 2023. After that amount phases down, they are going to change this tax law considerably. This was introduced again as part of Tax Job Cat Act. So, they possibly would roll over back to prior year, prior to 2017. They are proposing of cutting that additional accelerated depreciation you used to have. Technically, a lot of times, a lot of people used to accelerate that capital investment into machinery and those things because there was an accelerated deduction. So they are talking about currently it was supposed to phase out after 2023, but they might accelerate that from 2021 itself. They're going to reverse that law back. There's a recommendation. Again, this is not yet been updated. So these are all the areas which they're talking about reversing or changing it. Let's go to next one. We then go to next one. So they're talking about changing the net operating loss. NOL used to have in 2017 Jobs Act. Again, NOL. So NOL stands for net operating loss. So if you have net operating loss, you had an opportunity to carry back your losses prior up to 3 years, and then you can carry it forward. That was changed. So they are talking about adding that net operating loss carry back again, back to pre-2017 prior levels, which is a positive thing actually. This would help because if you have a business and if you are able to carry back your losses 3 years, or you can carry forward, then you technically get an advantage. In this scenario, this particular strategy would help you. It would technically, allow you to carry back your depreciation. You don't have to do it, but that's a choice. This is a good thing. If they bring it back, this would be an added advantage. It was actually taken away and it was brought back temporarily as part of COVID's stimulus act, which they allowed to people to carry back their depreciation for 5 years. But then, 2021, that law is not there anymore. So possibly they might bring this back and allow you to carry back depreciation for 3 years, which is a good thing. Go to next one. They're talking about overhauling estate taxes substantially. They estate taxes today exemption limits are $11.58 million or $23.16 million. So Democrats want to lower the exemption to 2009 levels, which is of $3.5 million, and a graduate tax rate and graduate tax up to 77% compared to today's tax rate of 40% flat rate. So they're talking about adding a substantial estate tax if your income is above, three, or if you're, if you pass on that to your kids above $3.5 million, then you're looking at a significant tax rate, which would go up to 77%. So this could be a big increase for people who want to pass on a sizable estate to their kids. So this, if you have high estate tax and if you are falling above the exemption limit, this could be a significant change. So if you are technically individual and you want to help yourself, I will recommend for you to technically take an advantage of estate tax exemption limit and technically, try to do something about estate exemption limit this year. You definitely want to not ignore this thing. Let's go next slide. Repatriation of corporate funds. US companies' overseas income held as cash would be subject to a 15.5% rate. Earlier, if you're a corporation and if you're withholding the tax rate, income into foreign country, did not pay taxes until the repatriation happened here because of the subsidiary structure. Now, in this scenario, even though you don't repatriate, they're talking about adding a 15.5% tax rate, while non-cash holdings would be facing an 8% rate. So companies can make the payments in 8 installments. This is significant increase on the tax rate. That is the current law. Let's go to the next slide. So individual tax rates. Let's come to individual tax rates. There are currently 7 rates starting at 10% and reaching to 37% for incomes above 523K for singles and 8,000 for married filing jointly. Let's go to next slide. This is the current rate. So 2021 tax rates, they are talking about increasing the tax rate. The lower 10% slab rate stays the same, does not change significantly. 12% slab rate also stays the same, no changes there. And technically, they are talking about that they are adding another income slab rate for, I think there is a 2021 typo there, but there is an income slab rate they are talking about adding on a 24%. They're increasing the limit to 329%. Sorry, for $329,000. 22% they're talking about increasing the limit to 172K. On 32% they're talking about increasing the limit to 418K. On a 35% they're talking about increasing the limit to 628K, and over 37% 628K, and they're trying to add another layer which is about 39% if your tax rate is increasing over $1 million or if your income is over $1 million. So if you're below $1 million, you would not have significant impact. You would have technically a little bit more higher limits, but nothing significant there. Let's go to next slide. So individual AMT can apply. AMT stands again for alternate minimum tax. Individual AMT can apply after exemption level of 7,200, 72,900 for singles and 113,400 for married filing joint. And the exemptions phase out at higher income. New law 2021, AMT can apply after exemption levels of $73,000 and 114 for married filing joint, and exemption phase out at higher income. So they are increasing a little bit of the limit. Nothing bad with that. So if you're technically, was paying AMT in 2020, you will continue paying AMT in 2021. But your exemption limits are increased by another $1,000 basically, which is not a big increase at all. But in the higher income slab rate, once you cross $500,000, they are adding significant AMT tax rates, which is not yet decided. Let's go to next slide. Overall of standard deduction, the current law is 12,400 standard deduction for single taxpayers and 24,800 for married couples filing. In new 2021, they are talking about 12,550 for standard deduction, and single taxpayers they are talking about 25,100 for married filing joint returns. So again, a recap of this thing, but they are also talking about bringing those itemized deduction limits back in. Let's go to next slide. Changes to itemized deduction, state and local tax deduction property. So that is a significant change they are asking about bringing to itemized deduction. Earlier, we had a phase out limit on state and local tax deduction. So they are going to change that back to what it was prior. They're going to remove the phase out limit. They are also going to remove possibly the phase out limit for mortgage interest reduction and medical expense reduction, which is a positive thing. So for individuals, if you're a W-2 filer or anybody individually, this would be a positive thing. Earlier, people complained for people who are eligible and paying higher mortgage and property taxes, specifically in taxable states, they had a big problem. But now with this change, this would technically help and advantage people who have high state income tax and the mortgage interest reduction. So they are talking about changing those limits back to prior years. So that is a positive thing. Let's go to next slide. State and local tax reduction. Individuals can deduct the state and local tax they pay, but the value is subject to certain limits for high earners. Now they are bringing an increase of $10,000 or more. So let's go to next slide. I think I just talked about that. Mortgage deduction we already talked about. Medical expenses. Qualified medical expenses that exceed 10% of taxpayers' adjustable gross income are deductible. Reduce the threshold to 7.5% of AGI. That is what they are talking about. A $2,000 credit for each child. Credit remains $2,000. In 2021, as part of stimulus, they are already talking about increasing the. They already increased the the child tax credit basically. It is provided for child under 17 to 2021. So they are talking about increasing the child tax credit for 2021 as part of the stimulus. So that is again going to be a positive. They are increasing the child tax credit limit to about $3,500 from $2,000. Let's go to the next slide. So now a lot of times people talk to me that what do you do if you technically want to plan in 2021? One positive thing that has happened as part of this last stimulus act that was passed in December, that they have increased the solar tax reduction, which was supposed to phase out to 22%. Now for 2 years, next 2 years, the solar tax reduction is going to be increased or kept at 26% instead of phasing out to 22%. So anybody who needs help, and I'm not talking about putting solar on your roof, we have mechanism where you can technically get a solar tax reduction and get 100% of your investment back in 1 year, and possibly get more tax benefit by depreciation. So if you were to invest $100,000, you technically get about $130,000 with all the benefits, because we special allocate the depreciation to you, and as other investors might not be eligible for depreciation, so the special allocation of depreciation happens to you, and you get 100% of your investment back. Ultimately returns to 130% of your investment on the solar business. So if you invest $100, you get $130 back within 12 months. So this is a very important thing, which is a very valuable tax planning, ability tool by investing into the clean energy and clean environment. And you should technically take advantage of this thing. So if you need any help about this thing, please talk to one of our team members, and we can help you. Can we do solar investment for 2020? No, you cannot do solar investments for 2020. If they allow the depreciation carry back, then you once you zero out your taxes, yes, you can technically carry back your depreciation for 2020 by amending your 2020 taxes. But you cannot technically do solar tax depreciation contribution for 2020 right now. But as I said again, they are talking about amending the depreciation laws and the carryback laws. And if the carryback laws are amended, then you are allowed to carry back your loss, depreciation loss for last year once you have zeroed out your income this year. Let's go to next slide. So this is, it's a quick process, how you can technically get an advantage of solar tax credit, and we can help you, connect you with the manufacturer. We can connect you by you owning your own solar plant. You're investing into your own solar energy, and you make ongoing returns as well. So it's not just investing into solar energy and getting depreciation and tax credits. It is also an ongoing income. So you're building an ongoing income portfolio for yourself as well. And we have an entire team of experts who can help you. We can refer you to. This is just an example of someone investing. Not choice A is do nothing and keep 35K at the bank and earn 1% interest. Choice B is technically invest 35K in solar energy business, ultimately generating 48K back to you, which technically means you are technically getting $13,000 extra in your pocket, which is give or take about close to 35 to 40% return in your pocket by tax changes and tax benefits itself. This is by not installing solar on your roof. This is by investing into a solar, based investment, and you own your own plant, and we would explain you how it is done. If you need any help, please email to info@perfecttax.com, and we would help you. Now, there is an additional next week. I'm going to cover the new stimulus law that has came in for Biden and how it affects you individually and what are the things you can do to take advantage of maximum stimulus law that was recently passed. What's in it for you as an individual tax filer, W-2 tax filer, or a business tax filer? So next Saturday, we would have the discussion same time. So we'll discuss in more detail about the stimulus law change that has come up, which was recently passed on last Friday. So let's go to next slide. This just gives you the same example. Net benefit of someone investing $30,000 is about $18,000 of all expenses, after all expenses. So you give or take are making about very decent return by investing into solar. So there is another benefit, this is again a structural diagram of the same thing, how it is done. So again, we can technically talk to you in much more detail when you come. Let's go to next slide. So business snapshot about solar is very simple. Single upfront prepayment to initiate business. option of lifetime residual income, option to exit business in 5 years. No need to worry about maintenance and warranty. Investors insure solar equipment for no loss. Manufacturer provides lifetime equipment warranty. So you technically get, a very decent return from the depreciation and tax credits and the residual income. All three combined together, you're making an excellent rate of return for yourself. Let's go to next slide. It just gives you a cash flow over life of the project, how much you make, how you make. I think we'll go to next slide. It also talks about how this breakup of 30%, 31% ROI works out. Again, this is case to case basis. So I would strongly recommend that you please come to our office and we'll walk you through how this cash flow works and how it advantages you. Go to next slide. Let's go to next slide. This is again details of the solar. We also have technically, a new mechanism where we can, as an individual tax filers, we would sit down and do a comprehensive planning with the new law changes that are coming up, where you are allowed to get under full understanding before you sign up that how we can add value back to you, and based on that value proposition, you can decide if we are the right fit, and at that point of time, you make a decision that what is the best case benefit, and then you technically buy our services. Our services of planning include the professional fees, and it covers your corporate tax filing, business tax filing, and personal tax filing, all of that combined together. So it is a very cost-effective solution which you can get. Go to next slide. So donor advice fund, I would like to talk a little bit about that. A lot of times, what donor advice fund really does is, donor advice fund, whenever you contribute to any donor advice fund could be with Fidelity, could be with anything. If you're donating money to charity, you get full control of how you grow that asset. And at the same time, you donate an asset, an appreciated asset, which you are able to get the tax write-off today, but that asset can keep growing for the benefit of charity in future. And if you do it correctly, we have mechanisms where, with the combination of your depreciation benefits, by investing into real estate projects and donor advice fund, both combined together, you can get 100% of money that you're donating today in your pocket. And at the same time, you can get a residual income of 12 to 15% a year for next 8 to 10 years, making a guaranteed stream of income to you. So what that really means is that the way we design it is such a way that you invest into a donor advice fund, and at the same time, you have a real estate project which you can take advantage of, which gives you a combination effect of donor advice fund and real estate project, ultimately delivering you 100% return of your capital back year one, and whatever you're donating. And at the same time, you are able to get the continuous stream of income of 12 to 15% by investing into a strong asset portfolio over next 10 to 12 years. So we can talk more in detail if you're interested about discussing that how a donor advice fund and a depreciation combination could add a lot of value to you yourself. Let's go to next slide. You can achieve multiple goals with this thing. You are contributing to charity. You are actually leveraging life insurance to leave a legacy after death for charity. And you are also getting depreciation benefits, which technically would give you a residual income also to you. And the charity money, whatever it goes to charity, we are able to get enough money back to you from the depreciation benefits itself. So honestly, money going to charity is coming back to you 100% from depreciation benefit. Go to next slide. This just gives you a diagrammatic view of what we are talking about. Again, tells you how we can help you. There are one-time fixed fees. Our fees are fixed fees on this model. These are new mechanisms, how you can technically optimize your charitable contributions, at the same time, leave money for the charity. And there are no loans involved. There are nothing involved. We are not asking about taking any money out of charity. You leave the money out for charity. But the way we do it such a way that you get an accelerated depreciation at the same on the money that you invest on the side, and the money staying from the charity also produces income for you, and it creates a stream of income for charity. Let's go to next slide. And there's a fixed one-time fee for that. This is again an diagrammatic representation. I'm not going to go to diagrammatic representation because it's very difficult for me to walk you through that. So my recommendation is that please talk to us how we can technically help you optimize the structure on depreciation and how we can maximize your benefits for the charitable benefits as well. Next week, don't forget to tune into the presentation at the same time, which will be focused more onto how you can take the full advantage of the current stimulus laws, the new, and I would update you also on some of the tax laws because we are going to hear more updates from Capitol Hill sometimes this week. So I would update you more that if what is the recommendation and proposal by Biden administration of the finite deduction amounts, finite depreciation amounts, and finite effects on the individual taxes as well. So we'll continue talking more about the same presentation, little bit more detail, and also talk about the stimulus law that has been passed and how you can take more advantage of the stimulus law. Go to next slide. So this just gives you an example and idea of how technically we can work on the depreciation part and how real estate could generate a very good stream of income for yourself, and at the same time it could be investing into great qualified assets, but at the same exact time it could give you a great depreciation benefits as well. So it's a combination. You're getting a depreciation benefits. So if your returns in a real estate project, let's say, is 8 to 10%, what we have seen is and I'm talking about in a good qualified assets like institutional class assets, like which has a fixed income. I'm not talking about development assets. So from the time you invest money, you do get residual income from quarter one. So you're getting 8 to 10% yearly income, and at the same time, with the depreciation tax benefits, your income taxes or your benefit increases even more, which could technically accelerate your total benefit to 12 to 17%. That is again a great strategy to help yourself save. Another thing, for people who are in high net worth individuals, which I would talk a little bit more in detail because we don't know the exact numbers, so I did not cover it today. The Biden administration has talked about wealth tax. One of the proposal was to add a wealth tax. If your wealth is above certain level or income is above $1 million, then you would be added. So if your net worth or if your income is annual $1 million or more, they are proposing, one of the proposal was to add a wealth tax. I doubted that would pass, but we would keep an eye on that. We'll see. I would talk a little bit more details through this weekly webinars, as I cover more and more details, as more and more information gets available to us from the Capitol Hill. Let's go to next slide. So this is the last slide of the day. Again, I appreciate everyone joining this webinar. I would talk to you much more in detail. I'm sorry I'm not able to take more questions today because I'm joining in from international trip. I would strongly recommend that if you have more questions about the new law changes, and as I said again, more and more details are coming every day. So as more detail comes, I will share more information with you. And keep tuning to this weekly webinars, and we'll talk more about that. We'll also talk about ideas. Send an email to info@perfecttax.com, or you can call us at 469-213-1519. Again, it's 469-213-1519, and we can talk to you in much more detail and discuss with you how it could work. Thank you everyone for joining us this afternoon. I appreciate that, and we'll talk in detail. I am apologizing for not being able to take questions. I normally take all the questions on the weekly webinars, but next week, as I said again, we'll go into details about each and everything what they are bringing. I have a very good friend in Capitol Hill who is going to share with me more information, and I'll share with you more and more information as it comes. Thank you again for everyone joining. Bye.